Greetings, members one and all of the Salivation Nation. Inflation is more likely now than ever. Gold is the answer. Let's explore. Yes, indeed. We've had a lot of very, very interesting events occur over the last couple of weeks here, months since the election. And now that things are really starting to take place, the reality of what it lies ahead for many of us in this country, in the United States, but also around the world, things are going to change. And I think they could change sooner rather than later in terms of our monetary system. You know, there's this talk of this great reset, and also what's been going on with many other nations and the International Monetary Fund's numbers and the like that they're showing their stimulus for the COVID-19 pandemic. That means inflation is coming. This article here from Kitco says that investors are expected to turn to gold as they brace for inflation. As of the recording of this video, we are seeing the stock market actually up. And I believe we could continue to see that going into the year. But I believe that gold and silver will rise. But gold is really the answer, I believe, to this. But let's talk a little bit about it here. And according to the International Monetary Fund, $12 trillion has been pumped into global finance markets as governments and central banks worldwide have tried to stabilize the economy that was devastated by the COVID-19 pandemic. Simultaneously, the Federal Reserve, which has led the way in central bank stimulus, has seen its balance sheet balloon to record highs above $7 trillion. So essentially, the United States is $7 trillion being spent during this pandemic, and the rest of the world, $5 trillion. If 2020 saw historic monetary and fiscal stimulus, analysts, economists, and investors are now wondering what the fallout will be, with many expecting to see higher inflation, especially as economic activity picks up in the second half of the year. And why is that? Because of the velocity of money will increase. A lot of this money that's been printed, and yes, I did say money, because believe it or not, fiat currencies are a store of value. It just so happens that that value is depreciating year in on year end by design, and this depreciation will probably occur at a higher rate, hence inflation. In its 2021 outlook published in October, the International Monetary Fund said that it sees the global economy expanding by 5.2%. According to projections, the U.S. economy is expected to grow by 3.2%, and the European Union is expected to grow by 5.2%. Although the IMF sees inflation pressures remaining low, the analysts noted a lot of uncertainties in their forecast. Price pressures could increase, for example, due to the release of pent-up demand as consumers increase spending on items that they had been forced to delay consuming because of lockdowns and restrictions on movement. They could also increase due to higher production costs from persistent supply disruptions, the IMF said in its report. The IMF also noted that government fiscal policies and central bank monetary policies could also quickly push inflation pressures out of control. And I believe that could be the case. We're under that threat more so now than ever with all this printing and stuff going on. But everybody's doing it. So I think here in the United States and the Federal Reserve and politicians alike probably feel like the dollar is safe because, hey, everybody else is doing it and we are a superpower. So why can't we and get away with it? The credibility of monetary policy frameworks can also affect price developments. Credibility can suffer where central banks are regarded as conducting monetary policy to keep government borrowing costs lower rather than to ensure price stability, which is fiscal dominance, the analyst said. In those contexts, inflation expectations can increase very quickly once governments begin running large fiscal deficits. According to the Federal Reserve's latest economic projections, core inflation is expected to rise by 1.8% in 2021, rising to 1.9% in 2022, and rise to 2% by 2023. Now, that's core inflation. I don't know if that's a different measure where they target inflation at being 2% and now increase to 2.3%. But nonetheless, the central bank's inflation estimate has less impact as it now targets the average inflation at around 2%. Although global markets are awash in historic amounts of liquidity. Now let that sink in for a moment. They're awash in historic amounts of liquidity. Many economists note that it will not significantly impact consumer price pressure. Many economists expected a sufficient stack in the global economy caused by the COVID-19 pandemic to keep consumer inflation pressures under control. Inflation pressures are unlikely to play any meaningful role for some time, which should keep monetary accommodation firmly in place. This bodes well for continuing recovery of activity once the pandemic is under control, said economist at Barclays Capital in his 2021 economic or outlook report. Bank of America is also not expecting to see significant inflation pressure, so there's differing opinions there on that. Most countries are running big budget deficits, but fiscal expansion is filling holes in the global economy, not triggering tight capacity and inflationary pressures, the analysts said in their 2021 outlook report. Of course, serious inflation is possible if policymakers do not reverse course as the economy hits full employment. However, that is unlikely until 2022 or even later. Don't hold your breath, they added. However, many market analysts note that just because inflation isn't expected to show up in consumer prices doesn't mean that markets and investors won't feel inflationary pressure. And that's just it. It's very difficult to kind of really measure. Many of us look at the measures of bread, milk, eggs, necessities going up crazy. Now gas prices are rising again. In a sense, that's inflation. But a lot of that is based off of commodity markets as well, too, like oil. So it's kind of tough to really gauge that kind of movement in price as opposed to inflationary pressures. How this stuff is measured, consumer price index and the like, taking that into account is a kind of an art and science, I would venture to guess. In a recent interview with Kitco News, Bernard Dada, precious metal analyst at Natixis, noted that instead of driving consumer prices, the excess liquidity is going into capital markets, driving equity valuations to record highs and inflating real estate values. Very interesting. He added that these inflation pressures are still bullish for gold. The precious metal has become an important diversifier and hedge against overvalued markets. And I do agree with that. These inflation pressures, by the way, I believe are something that we're going to really feel this year, even if we don't see hyperinflation this year. Chantel Chivin, head of research at Murrenbeet and Company, said in an interview with Kitco that her economic base case for 2021 is for muted inflation. However, she added that there's still a lot of uncertainty in financial markets, and it would take much to drive inflation higher. There is a lot of money supply in the market, but there is a lack of velocity, and that is what drives inflation, she said. To get velocity, you need people to go out and spend. Even with more stimulus, we don't see consumers' spending habits change, and that's probably one reason why probably Congress is fine with all this money that's giving out, $600, and then it moved it to $200 or $2,000. Which is probably more likely to happen now than ever with the new Congress, and especially with the recent elections in Georgia. While inflation is expected to remain subdued, many analysts say that it won't take much to drive gold prices above the 2020 all-time highs. The Federal Reserve is expected to leave interest rates at the zero-bound range through 2023. Currently, real interest rates are hovering around negative 48 basis points, Heading into the new year, the value of global debt with negative yields rose to a record $18 trillion. The amount of negative debt out there is massive. $18 trillion is a disgusting number, said Steve Dunn, head of the exchange traded products in Aberdeen Standard Investments. Dunn added that bond yields are expected to go even deeper into negative territory as inflation picks up. He added that in this environment, gold is becoming more attractive as a safe haven asset. Rising inflation pressures in a low interest rate environment tell a very good story for gold prices in 2021. That really sums it up. Rising inflation pressures, which means that we may not necessarily see the inflation, but understanding that the road is leading to it. And when it happens, and look where gold is now. Gold is trading at near record highs again. It's lower again today. The prices kind of have subdued after the events at the Capitol yesterday, but nonetheless, they are still in this record territory. For all intents and purposes, we're pushing, getting closer to $2,000 a level for gold. Now, why don't I include silver in this? Because silver is kind of seen as a commodity, and I do believe silver will rise along with gold, but I believe its volatility may prevent it from being the ultimate safe haven asset. In other words, we may see prices go up. We may see the gold to silver ratio even narrow, but the volatility of the price movement for silver may be as such that it won't translate to being something that people can feel very secure or extremely secure in. They can feel secure in it because I do believe it is a hedge. I do believe it is an asset that has proved itself over the course of time, but over the last 5-6 years or so, really essentially since 2011, gold has or silver has been volatile and been seen more as a commodity than ever before in the marketplace. So there you have it. Toward the news for today, where we are heading in 2021. Let me know your thoughts in the comment section of this video. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.